silver is no longer just another ordinary rally story. Beneath the surface, a combination of forces is building that reminds many analysts of the 2021 silver squeeze, but this time, the conditions appear very different. And if this setup fully develops, the move could become far more aggressive and much more sustainable than before. Back in 2021, the silver squeeze became a massive trend online. Reddit communities, retail traders, and social media campaigns created intense excitement around silver. Within days, silver jumped from around $25 to nearly $30, but the rally quickly collapsed. Many retail investors were left holding losses, and the market eventually dismissed the event as a failed experiment. Today's environment, however, looks very different. The first major difference is institutional participation. In 2021, the squeeze was driven almost entirely by retail traders. Large funds and professional commodity investors stayed mostly on the sidelines. This time, billions of dollars are flowing into silver mining stocks and silver-backed ETFs. That suggests serious institutional capital is entering the silver market alongside retail investors. The second major factor is physical supply. During the previous squeeze attempt, shortages were mostly seen as speculation. Now, inventory levels are visibly declining. Comex registered silver inventories have dropped significantly over the past few years, while premiums on physical silver products remain unusually high. Normally, higher prices reduce demand, but in this cycle, buyers are still aggressively purchasing physical silver despite elevated prices. The third important factor is delivery demand. In 2021, most investors gained exposure through paper products like ETFs and speculative positions. This time, actual delivery requests in the futures market are running much higher. That means investors are not only betting on silver prices, they are demanding real physical metal. These three elements, institutional participation, tightening supply, and rising delivery demand, are now happening simultaneously. That is why some analysts are calling this setup silver squeeze 2.0. Several additional catalysts are also making the current setup even stronger. A weakening US dollar is creating a favorable environment for precious metals. Historically, silver tends to perform well during periods of dollar weakness. At the same time, industrial demand for silver is expanding rapidly. Solar panels, electric vehicles, semiconductors, and modern electronics all require large amounts of silver. Unlike speculative demand, industrial demand permanently removes silver from the market. The gold-to-silver ratio is also compressing, which often signals that investors are rotating from gold into silver in search of higher upside potential. If inventories continue falling at the current pace, the market could eventually approach psychologically critical levels. History shows that when institutional positioning, physical shortages, and social media-driven retail momentum align at the same time, price movements can become extremely volatile. However, none of this guarantees a specific outcome. A global recession could weaken industrial demand. The US dollar could suddenly strengthen again. Large vault holders could also release additional supply into the market, temporarily easing the pressure and delaying any potential squeeze. That is why experienced investors rarely go all in. Instead, they prepare for multiple possible scenarios. Right now, the key question for the market is this: will silver continue a slow and steady rally, or is a powerful parabolic move about to begin? Over the coming weeks, investors will be closely watching inventory levels, ETF inflows, mining stocks, and physical silver premiums. If all of these signals continue accelerating together, market sentiment could shift very quickly. And history has repeatedly shown one thing about precious metals markets: by the time the crowd fully realizes what is happening, the early opportunity is often already gone.